Hello and welcome to Money Maximized. Today we are going to talk about debt repayment ratio. The term debt repayment ratio is not a standard financial ratio commonly used in financial analysis or reporting. However, it seems to refer to a metric or concept related to a company's ability to repay its debt, which is a crucial aspect of financial management and analysis. To provide a meaningful explanation, I'll discuss several ratios and metrics that are directly or indirectly related to debt repayment. Debt Service Coverage Ratio, DSCR. This ratio assesses a company's ability to cover its debt servicing costs, including interest and principal repayments. DSCR is calculated by dividing net operating income by total debt. The higher the DSCR, the more comfortably a company can meet its debt obligations. Lenders often use this ratio to evaluate a company's creditworthiness. Debt to equity ratio. This ratio compares a company's total debt to its shareholders' equity and indicates the extent to which a company relies on debt to finance its operations. A high debt-to-equity ratio may suggest higher financial risk. Interest coverage ratio. This ratio measures a company's ability to cover its interest expenses with its earnings. It provides insight into whether a company can comfortably manage its interest payments. Interest coverage ratio is calculated by operating income, earning before income tax, divided by interest. Debt ratio. The debt ratio expresses the proportion of a company's assets that are financed by debt. It is calculated by dividing total debt by total asset. Debt repayment capacity. While not a ratio in itself, assessing a company's debt repayment capacity involves evaluating its cash flow, profitability, and liquidity to ensure it has sufficient resources to make timely debt repayments. Debt maturity profile. Examining the maturity dates of a company's debt obligations is crucial. A mismatch between when debt is due and the company's ability to generate cash flows can pose repayment challenges. Working capital management. Efficient. Working capital management, including managing accounts receivable and inventory, can free up cash that can be used for debt repayment. Debt restructuring. In cases of financial distress, a company may need to negotiate debt repayment terms with creditors or explore options such as debt consolidation or refinancing. Typical ranges for important debt-related ratios. Debt-to-equity ratio. A lower debt-to-equity ratio, less than 1, suggests that a company relies less on debt financing, which can be seen as lower financial risk. A higher debt-to-equity ratio, above 1, indicates that a company has a significant portion of its financing coming from debt, which may imply higher financial risk. Debt ratio. A lower debt ratio, less than 0.5 or 50%, indicates that a smaller portion of a company's assets is financed by debt. A higher debt ratio, above 0.5 or 50%, suggests that a significant portion of a company's assets is financed by debt. Debt Service Coverage Ratio, DSCR. A DSCR above 1 indicates that a company's cash flow is sufficient to cover its debt service obligations comfortably. Lenders often require a DSCR of at least 1.2 or higher for loan approval. A DSCR below 1 suggests that the company may have difficulty meeting its debt service obligations, which can be a sign of financial distress. Interest coverage ratio. An interest coverage ratio above 2 or 3 is generally considered healthy. It indicates that the company's earnings are comfortably covering its interest expenses. An interest coverage ratio below 1 indicates that the company is not generating enough operating income to cover its interest costs, which can be a red flag for financial stress. It's important to emphasize that these ranges are general guidelines and may vary depending on factors such as industry norms, economic conditions, and the company's specific circumstances. Additionally, it's crucial to consider these ratios in conjunction with other financial metrics and qualitative factors to get a comprehensive understanding of a company's financial health and its ability to manage debt repayment. Always consult with financial professionals or experts in your specific industry for more precise guidance. It's essential to note that while these ratios and metrics provide insights into a company's debt repayment capabilities, they should be analyzed alongside other financial information and industry benchmarks. Additionally, the specific ratios and metrics used may vary depending on the context and the stakeholders involved in evaluating a company's financial health. Thanks for watching, and don't forget to like, share, and subscribe.